All right, welcome back, class. In today's lecture, we are going to talk about stock option properties. So specifically here, and here's our agenda. We're going to talk off a little bit about the notation we're going to use, some of which you've already seen, and the impact that some of the parameters for the pricing of options has on the actual call and put prices. Then we'll jump in and talk about, we'll use arbitrage-based arguments to define the upper and lower bounds for a put or call price to derive our main pricing condition called the put call parity. Then we'll extend the put call parity condition to flex, if you will, for decisions on American style call options where we may or may not want to exercise the option earlier than the maturity date. Obviously, this is only for American style options. Last but not least, we'll show how dividends impact some of those decisions and how it impacts the put call parity condition. So, jumping into item number one here, let's discuss the notation and the impacts on the asset price itself. So you'll notice here we're defining uh, the call prices, and specifically it's the call premium, right? So we're going to denote that with the letter C. For a European style call option, that's going to be a lowercase c. For an American style call option, it'll be an uppercase C. We do the same sort of notation for a European style put option that is a lowercase p is the put premium that a put buyer would pay. And for an American style call option, that would be a capital P. The stock price today, we've seen before, this is just S of 0. The stock price at maturity would be S of T. Um, Strike price denoted K. The present value of dividends denoted capital D. The life of the option in terms of time to maturity in number of years is capital T. And sigma here is going to indicate the volatility of the underlying stock price. All right, so that's the notation that we need to get moving here. So let's talk about the impact of all of those variables we just defined. So by variables, I mean everything here in the left-hand column, and the impact it has on the call or the put price, C or P, in the case of a European style option, or capital C and P in the case of an American style option. Um, so the way you want to read each one of these cells is the impact that for example, I guess in sort of calculus talk, we would call this the sign of the partial derivative. That is how the option price moves when that one input rises, if we're holding everything else fixed, okay? So in the case of the stock price, this row basically tells us that a call price for both a European and an American style call option goes up when the share price today goes up. The opposite happens for a put option, which should make sense, right? Because a call option is a bullish bet, a put option is a bearish bet. The opposite is true for a strike price increase, right? So if the strike price increases, then it has a negative impact on the call option. You can see that in both columns here. And it has a positive impact on the put options. And the idea there is rather simple. If you increase the strike price, then it's less likely that the call option will be in the money, and it is more likely that the put option will be. Um, the time to maturity is unambiguous for a American style call option because more time to maturity can never hurt the value. For a European style call or put option, the sign's ambiguous because extending the time to maturity can mean potentially an extra dividend payment that falls within the life of the option, which would depress the underlying asset value, right? So we know that, when a stock pays a dividend, for example, the share price decreases by the amount of the dividend. So it's somewhat ambiguous if there's going to be additional dividend payments involved in there. Volatility is always good for options, regardless of the option type, right? So if volatility of the underlying stock increases, then the value of the put and the call option increases, period. For interest rates, this one's a little bit more challenging to understand. Um, Generally, interest rate increases will increase the value of a call option and it depresses the value of a put option. The way you want to think about this is that a higher interest rate makes the present value of the strike price smaller, which would help the call buyer, right? If the strike price becomes smaller, right, the present value of it would be helpful, and thereby it also hurts the put buyer. Dividends do the opposite of what the share price does, right? So as there's an increase in dividend payments, right, that theoretically lowers the stock price, so it negatively impacts calls and conversely positively impacts the put prices. So last but not least, we'll take from this, because an American style call option can be exercised before maturity and a European one cannot, it must always be the case that the American style is at least equal to or greater than the European style for both calls and puts here. So that's what we conclude the deterministic slide here, the effect that the variables have on different option pricing. Now going into section 2 here, we are going to discuss the boundary conditions through an arbitrage argument to define the put-call parity condition. So we're going to start with determining what the lower bound is for a call option. So here's our parameters to start with. We're told that the call premium is $3. Time to maturity is a year. Strike price at 18. We have the share price at 20. We have the risk-free rate at 10% and a dividend at 0. All right. So just to give you sort of a visual here, since it's been a minute since we've looked at one of these charts here, right? If this is our um, share price along this lower axis here, and this is our payoff. I'm going to call it our profit function, right? Let's say our strike price here is at $18, and we know that our share price is slightly above that at $20 currently. So I'm just going to write it real small here if I can, 20 bucks. And so because we pay, the cost of this thing is $3, we're going to shift it down from the 0 line by $3, right? So our profit function looks something like this. This is what we're talking about here, right? Visually, at least. Okay. So the first question is there an arbitrage opportunity? Well, when we plug in our intrinsic value formula for this European style call option, and we know it's European because I've used the lowercase c over here. We know the share price is 20 bucks, plug that in. And then when we back out the present value of the strike price, and we use the present value of the strike price because this European style call option cannot be exercised early. So it's not just S minus K, it's the present value of K, right? And when we plug that in, we see that the theoretical value for this particular call option should be $3.71, but it's trading in the market at $3. So it must be the case that we have an arbitrage opportunity here. So what do we do? All right, so we create the arbitrage. So what's the cheap thing in this thing? And what's the expensive thing? Well, the cheap thing is the actual call option. So that's our action today. We buy the call option at $3. But where do we get that money from? Well, we short the expensive side. So we short the stock. So we get that $20 by borrowing it and selling it into the market. We spend $3 on the option. and then we invest the remainder at $17 at that risk-free rate of 10%. So our net cash flow today, this is all zero. Um, when it comes to the maturity time period, right? So at S of T, that is when the share price at maturity, we're not sure what it's going to be, but we can evaluate it relative to the strike price of $18. So if the share price is below $18 at maturity, T equal to 1, well, the option will have expired worthless because it's out of the money. So we're not going to exercise it. So then we just close our short position by entering the market, right? So we have to pay whatever the share price is, hence the negative sign out front here. And then we're going to receive our principal plus our interest on our investment or our loan, if you will, that we made to the government here in the form of a risk-free treasury bill. So we get back $18.79. So um, we know because it must be the case because we're evaluating the share price if it's below $18. It must be the case that the share price is below $18, and therefore a profit must be at least 79 cents if the share price is below $18, the strike price. If the share price is above the strike price at maturity, well, then it's in the money. So we exercise the option, which means we get the shares delivered to us, positive ST, and we pay that $18 per share. We still close out the short position and we still get our investment proceeds of 18.79. Our STs cancel here. And so we're left with exactly 79 cents in the arbitrage. And so through this arbitrage argument here, we've just proved that the lower bound must be the lower bound for the value of the call option is either the max of the difference between the share price and the present value of the strike price or zero. It can't go negative, right? So that is our lower bound condition for the strike price and what that looks like visually, at least, right? So it's a similar picture as we drew above, except I'm going to draw it slightly different here. Right? If this is our share price, here we're saying that it's the difference between the share price and the present value of the strike price. So slightly less, right, than the actual, if K is here, then the present value of it is slightly less. And so you could draw that as a function. It's no worse than zero, or the difference between the share price and the present value of the strike price. All right. Now we'll talk about the lower bound for a put option. Okay, so we'll do a symmetric argument here, a similar argument. We'll define the parameters real quick. Let's say the put option is $1, time to maturity 6 months, strike price is 40, share price is 37, so it's in the money, right, by $3. And risk-free rate's 5%, no dividend. Question is there an arbitrage opportunity? We set it up the same way. Remember, a put option is in money if the share price is below the strike price. Because we're dealing with a European style put option, the strike price, we're just taking the present value. Same argument as before. And we see that the theoretical value, present value of the strike price minus the share price of $37 is $2.01. Well, the put option is trading for $1, so there's an arbitrage opportunity here. We set it up the same way. Since the put is the cheap item in this arbitrage, we buy the put option, and we also buy the stock option. I'm sorry, the underlying stock for this arbitrage. And then we borrow that $38 at the prevailing rate of interest for this particular example. We wouldn't want to buy the put option and short the stock. Then we'd be double bearish on the stock, right? That'd be the opposite side of the trade. We're trying to create a no arbitrage or a no loss situation, meaning, and you can think about it this way. The put option pays off when the share price goes down. And if you hold the stock when the share price goes down, you lose money. So that's a 1-for-1 offset. So it offsets that risk. Now, we want to evaluate the share price at maturity relative to the strike price. So if the share price is below the strike price of 40, well, it's a put option. So it ends up in the money here. Hold on a second. I lost my camera. There we go. Brought it back. Um, it looks like it ends up in the money here. And so the stock that we buy while we're holding it, so it's positive ST in terms of what's sitting in our accounts. And then we have to repay our loan. And so we can see the STs cancel here. And so we receive, the value of the strike, $40, minus however much it costs to repay, $38.96. We end up with exactly $1.04. If the share price ends up out of the money, that is to say above the strike price of $40, well, we don't have to worry about the put option. So we're just sitting on the positive value of the stock because we know the stock's going to be above $40 because we're evaluating that scenario. So this must be worth at least $40 minus however much we have to pay back. So at least $1.04. So through this arbitrage argument, we've proven that the put value, the put premium, must be equal to or greater than the maximum of the present value of the strike price and the share price, or, and that's what the comma here is, or zero. Or said differently, I'm going to draw a similar argument here as we did last time for the share price. So if this is the strike price, this is K, then the present value of the strike price is something lower. All right, so K negative RT. And so the put option has a payoff function that looks essentially like this during the life of the maturity. It's, out of the money, so worth zero, right? So the maximum of zero or the difference between the strike price, the present value of the strike price minus whatever the share price is at that time period. Okay. Now, the this leads us to a construction for the put call parity condition. And I'm going to do it using two portfolios. That is essentially the way we just set up the arbitrages on the prior slide. So for that first lower bound call option, we were taking a look at the European call option and a zero coupon bond paying the strike price at time T. That was equivalent to us investing our money, right, into a bond that pays off the strike price at the maturity. So that was that first portfolio, that arbitrage that we took. The second arbitrage we took was combining a European put option with one share of the stock, right? So these are these two portfolios that we constructed. And here's what's interesting. I want to show you what the payoffs look like for these two these two portfolios. So portfolio A is a long call and a long investment in a bond, okay, that pays off K. So you can see in the payoff world in the future that if the share price is above the strike price, well, the call option ends up in the money. So this is the payoff. And if it's out of the money, that is the share price is below the strike price, it's out of the money, so it's worth zero. In all cases, the zero coupon bond is worth K at maturity, right? So the total payoff, if you will, is ST in a situation where the share price is above the strike price, so the value of the shares, and when the share price is below the strike price, then it's just the strike price, right? Because you can see the K's cancel here. So you end up with ST in this situation and K in this situation. Well, if you take a look at portfolio B, a long put option, it's worth zero if it's out of the money when the share price is above the strike price, and it's worth the difference between the strike price and the share price if the share price is below the strike price. And the other part of this portfolio B is a long position in the shares, while that's ST in both situations. And so you'll see here that this portfolio sums to a similar conclusion. That is, it's equivalent to the share price if the share price is above the strike, and it's equivalent to the strike price if the share price is below the strike price because these STs cancel out here. Okay. So what does that mean? Well, it must be the case that portfolio A and portfolio B, through the no arbitrage argument in the law of one price, it must be the case that they're equal to each other today, right? That is, you combine a call option and the present value of a strike price must be equal to the combination of a put option and the underlying shares. This is our put call parity condition, and it holds absolutely. In the particularly in the case of a European style option. We'll talk about deviations from it in a little bit. So to prove that it holds, let's take a look at a potential arbitrage when the two sides disagree to see if we can make money from it. Okay. So here's our parameters. Here's some parameters for a call option that's also quoted with a put option at this price, right? So the call option is $3, 3 months to maturity, strike price 30, share price 31, risk rate 10, dividend 0, and the put option price is 225. So now we check the parity condition. The left-hand side of the put call parity equation is as follows. We plug in the $3 call premium and we calculate the present value of the strike price. And this gives us a value of $32.26. We evaluate the right-hand side of the equation. The put price of 225 plus the share price, well, that's clearly higher than the left-hand side. So the right-hand side is too rich. And so the arbitrage follows. That is, we short the expensive side of it, the right-hand side, and we go long the left-hand side. What does the long left-hand side look like? Well, it looks like we buy a call and invest the remainder. Well, I'll get to the remainder part in a minute. And we generate money by shorting the right-hand side. That is, we short the stock, so we get $31, and we short the put, so we get the put premium. So we earn $33.25 in shorting and put premium. We spend 3 of that on the call option, and then we invest the remainder over the next 3 months. Okay. Then finally, we have to evaluate the payoffs. Of course, we're going to evaluate it relative to the strike price of $30. So if the share price is below 30, the call option is worthless. The short put position is in the money, but since we wrote it, we're on the hook for that. So that's why we have the negative sign out in front, showing the difference between the strike price 30 minus the share price here. We short the stock. We know in this situation, right, we're closing out the position at a price of ST, so we have to enter the market and buy back the stock. But we know the stock at this point in time is somewhere below $30. And last but not least, we receive our 3102 from our investment. And so we can see here, if we distribute the negative sign through through this equation, we see that there's a positive sign in front of ST, which cancels the action we have to take in the market to buy back the stock. And so we're left with 3102 minus 30, or strictly $1.02 in terms of arbitrage profit. And you would do this all day long, of course, until the put option becomes less costly through all the shorting action. That is, you're shorting it a lot, or the call option increases in value. We evaluate it same way if the share price is above 30. If it's above 30, the call option's in the money, so it's ST minus 30 is our payoff. The short put that we wrote's out of the money, so 0 value. And then the short stock, again, we enter the market, purchase it, and we get our money from the loan. These STs cancel out. We have the same arbitrage argument here. Both of these hold strictly because we can see both sides of the equation. We're not evaluating the lower bound properties here. So the arbitrage holds regardless of where the share price ends up. So put call parity in action here. Now, we've talked about the lower bounds of the call options and the put options, and this led us to the construction of put call parity. Um, we haven't talked much about the upper bound of the option. So when we take a look at call options, we've already defined this lower bound, so I'm just rewriting it for you. Um, and the reason it's not generally speaking, I'll come to this in a minute, this lower bound condition. In the case, well, actually, I'll talk about it now. In the case where there's no dividends being paid on the stock, you'll notice here I'm talking about American stock call option with capital C. And the reason why this also holds for an American style call option is that the present value, the difference between the share price minus the present value of the strike price exceeds the immediate exercise payoff, S minus K. Why? Well, because the present value of K is smaller than K, right? So an American call option is worth more, quote unquote, alive than if you were to kill it by exercising it. So no rational holder would exercise this early when there's a non-dividend paying stock. That's a rule. I'll talk more about that rule in a minute. As far as the upper bound, it should make sense that if the call option is way in the money, that it basically approaches the share price. It can't be worth more than the actual underlying share price. That wouldn't make any sense. If so, otherwise you would, sell the call option and buy the stock and just pocket the difference there. For put options, that also on non-dividend paying stocks, um, we take the American style options here. There are situations in which you might want to exercise an American style put option early, even for non-dividend paying stocks. And so you'll see that it is strictly we're not discounting the present value for an American style option here, either for the lower bound or for the upper bound. And in terms of the upper bound is essentially, the value of the put option can't be greater than the strike price, right? Because the stock can only go to zero, right? And so if the strike price is $100 and the stock goes to zero, then the max value of that put option is also $100. Um, okay. Now let's talk a little bit about reasons why you may or may not want to exercise an American style option early. Um, Generally speaking, American options do carry some early exercise value, specifically deep in the money put options when you have high interest rate environments and call options just before a large dividend is paid. I've mentioned this exception already. That is, an American call option on a non-dividend paying stock should never be exercised early because we can only sell the call for more than its, intrinsic value, right? Instead of exercising it for exactly the intrinsic value. Um, And the way to think about that is the way we showed it in the prior lecture. So if this is our share price, of course, um, here we go. Here we go. Share price. This is our strike price. So generally, the intrinsic value of the option, this call option, would look something like this. This is the intrinsic value if you were to exercise it, right? The difference between of S and K. But in practice, of course, the options have a value that sits above this line. That is, it looks something like this. So instead of exercising it, let's say the share price was at some price here, S prime. Well, you can see if you draw a line down, right? I'd rather receive this value, right, than the intrinsic value, which is clearly lower. So I would sell, right, as opposed to exercise and collect the lower price. So here's an extreme situation for a deep in the money American call option. Um, And the question is, should I exercise this thing immediately? Here's our situation. So it's deep in the money. Share price is $100. Strike price is $60. Time to maturity is pretty short, 3 months, no dividend here. Um, this in case number one, let's say I want the stock, which means I want to exercise this thing, pay the $60 so I can receive the stock. Well, you still don't want to exercise now. Why? Because I can hold the call and exercise this at expiration. I'll still get the stock, but then I'm deferring the payment of the $60 for another 3 months, right? And so that's clearly, um, that's clearly better off doing that, waiting a little bit longer because my money has value, time value. Especially in a case where there's no dividend being paid, right? Because I'm not going to get any payments. So it doesn't make sense. I can wait. Let's say I don't want the stock. Well, then I just sell the call, right? So this is the argument I just made before. Um, and importantly, what's nice is the if I were to exercise early, then I would be holding the stock. And if then the share price falls below the strike price over the next 3 months, then the call expires worthless, even if I don't sell it, instead of leaving me with a large losing position in the stock price, right? So let's say, for example, just to put numbers to it, I give $60, and I get the stock. And then over the next 3 months, I see the stock fall from $100 down to $25 while I'm holding the stock. So not only, I'm out of money, I've lost money on the position that is between the difference between 60 and $25. And so if I'm just holding the option, well, it just expires worthless. No big deal, right? I just lose the premium that I paid for it. Um, Here's a proof sketch of the argument we just went through here. So if we consider the two different portfolios, we'll see that one dominates the other in every case. So I'm evaluating a portfolio of buying a call option and versus buying the share by borrowing the present value of the strike price. So if the share price is below the strike price, the option's worth nothing. If it's above the strike price, well, it's the intrinsic value, right, at expiration. Conversely, if I buy the shares by borrowing, well, I always got to pay back what I borrowed, so the minus K, and then I'm holding S of T, which is fine in a world in which the share price remains above the strike price because these payoffs are the same. But in a world where the share price is below the strike price, this portfolio number two is dominated by portfolio number one, right? Because clearly the share price is below the strike price, so I've lost money here. So portfolio one's payoff is always better than or equal to portfolio two's payoff, so it must cost at least as much today. Said differently, a call on a non-dividend paying stock will never be exercised early because they can always sell it. And so we end up with this pricing condition, right? So a call option, this is lower bound, right, is greater than or equal to the difference between the share price and the present value of the strike price, right? And this difference, of course, must always be greater than strictly the difference between the share price and the strike price. Again, it's a lot worth more alive than dead. What about puts? Should they be exercised early? Sometimes, yes. And so here's an example to prove this, okay? So the share price is at $60 relative to the strike price of 100, so it's $40 in the money. Again, 3 months to maturity, same interest rate, no dividend. Should we exercise now? The answer is yes. A couple of reasons. Number one, it has almost no time value, right? It's 3 months to maturity. It's not a lot of time. It's deep in the money. So the put behaves a lot like the underlying share price. So while the additional time does give extra optionality, there's very little that's sacrificed by exercising it now. That is to say, we get $40 now. Reason number two, we get the $40 today, right? We're not paying that $40. We receive that $40 today. So when we exercise, we're delivering, right? We have the right to sell these stock at $60 per share. So it delivers us $40 in intrinsic gain immediately. And waiting only delays receiving that money. There's some time value having that cash in hand. And then reason number three, we can get interest on the proceeds, right? Especially if interest rates are high, which, 10% risk-free rate, it's pretty high. Um, we can reinvest the cash we have on hand today. Now, let's talk about situations in which dividends are being paid, specifically the impact it has on call options. So our never exercise early rule breaks down when there's a large dividend that is about to be paid imminently. So this is a very extreme example, but it proves the point. Share price is 105. Strike price is 100. So this is in the money by $5, right? So that's the intrinsic value. Now, we're also told that this stock is about to go ex-dividend and pay a giant $95 dividend. So this changes the equation a fair bit. If we exercise now, we get the intrinsic value difference, the $5, right, plus the $95 dividend because we're going to exercise and receive the stock and then get the dividend. So we receive the stock, we pay $100, it's worth 105, so that's a $5 gain to us plus the $95. So we gain $100. If we hold the call through the ex-dividend date, well, we know that the value of the shares must fall by the amount of the dividend, so the shares will drop from 105 minus 95 to $10. The call is effectively worthless at that point. So that's a situation in which we would want to exercise early to take advantage of that dividend, right? So only if it beats the time value that we give up, and it's a judgmental. It's more about judgment in this case, but it seems rather clear to me that this would be a situation in which you'd want to exercise early to receive this. All right, so just to summarize, the three forces that drive early exercise decisions, it's opposite typically for calls and puts. So for high volatility, it increases the value for both calls and puts, so it's a good thing. So it would defer early exercise decisions. Time value, well, the effect it has for call options, time value is positive with regards to, I'm sorry, time value is positive for the value of call options, so we would defer early exercise. We would do the opposite for put options, right? The time value collapses pretty quickly, particularly if it's deep in the money, so we might accelerate our decision to exercise that put option. And last but not least, the one we just went out, for call options, if it's dividend paying, we would accelerate our decision to exercise. For put options, if it's dividend paying, well, that has a downward drag on the stock price, therefore making puts more valuable. So we would defer early exercise for put option on the dividend paying stock. And so what do these dividends have in terms of the impact of the intrinsic put call parity condition? Well, it enters the lower bound equations as follows. For the call option, it enters between the strike price and the share price. Specifically, you can think about the dividend being a drag, hence the negative sign, on the underlying share price. And so it enters as a negative sign here for the call option. The puts gain because a dividend is a drag on the share price, yeah. So it's actually a positive impact for the put option values. So you see that here enter as a positive sign into the lower bound condition for put options. All right. And so just to kind of summarize what we've done in terms of extensions to put call parity for European and American style options. American options are going to give these inequalities because we can exercise them earlier. But strictly speaking, this is our initial put call parity pricing equation for European call options when there's no dividend being paid. Again, on the left-hand side, we have the call option and the present value of the strike price, or another way to think about this is a zero coupon bond, the price of a zero coupon bond today. The right-hand side is a combination of the put option and the underlying shares. The American style option that pays no dividends modifies this equation this way. A little bit ugly here, but it's just a rearrangement a bit of the equation because we have to account for the fact that in the case of a call option, we're not going to exercise this thing early and when it pays no dividend, hence we're not taking the present value of the strike price. And then on the right-hand side of this sort of inequality, we have this situation here where we are taking into account that the fact that put options may well be exercised early, regardless of dividends for an American style option, hence the present value of the strike price. Sorry, the intuition, sorry, that intuition is a little backwards here. This present value of the strike price kind of corresponds to this call option right here, because these won't be exercised early. And again, the full strike price would be relative to this put value. And this is just a combination of the algebraic rearrangement of the upper and lower bound conditions for an American style option for calls and puts. Now, when you enter the dividends for a European option, pretty simple. It just enters here on the left-hand side as a positive sign. And for the American style option, it enters here on the left-hand side as a negative sign because, again, it detracts value from the underlying share price. So some key takeaways from this lecture. We got three big ideas here. Number one is that our put call parity condition ties everything together. It pins down the four prices. And we can use this for creating synthetic positions, which we'll explore in the next lecture, and other sanity checks and arbitrage detections. This is our key identity here, right? Put call parity. Option number two, or sorry, key takeaway number two, we never exercise American call options early when they pay no dividends. You can always sell it for more or never exercise it. You're always strictly better off. And key takeaway number three, dividends flip that logic. They depress the value of a call option and increase the value of a put option. So it has to it reopens this, idea that we might want to exercise call options a little bit earlier and defer put option exercises when there's, dividends being paid. Okay. With that, we'll leave it there. And when we return in the next lecture, we will talk about option trading strategies. See you in a minute.